European banks are often in the headlines for all the wrong reasons at the moment. Not a week that goes past about another slew of negative headlines. But credit investors are required to be a bit more dispassionate and look at the actual fundamentals rather than the negative sentiment. And if you look at the Markit iTraxx senior financials, it's rallied from 200 basis points back in March, shortly after the index roll, to 95 basis points this week. That's the first time it's breached 100 basis point level since April 2010. Central bank largesse and improving economic fundamentals have driven risk assets higher across the board. With banks, it's quite interesting because their earnings have actually been quite weak. But the difference is that credit investors are generally concerned with the strength of the balance sheet. And banks, the vast majority of banks in Europe, have strengthened their capital positions over the past year or so. And one of the main drivers for that has been regulation. At a European level, there's been huge pressure to bolster balance sheets. The ECB is taking over as a single supervisor of banks, and the European Banking Authority has laid out stress tests and an asset quality review for next year, and that will inevitably result in quite a few banks raising more capital. The most vulnerable institutions in Europe are probably the ones based in the periphery. We saw this week Monte dei Paschi. That's generally viewed as one of the most vulnerable banks in Europe. Spreads trade very wide. But there was good news this week because it announced a €3 billion rights issue. That's a capital hike, and that will strengthen its balance sheet considerably. We saw CDS spreads tighten into 355 basis points. Not too long ago, they're trading at 730, so that's a massive improvement. But the real big improvement was in subordinated CDS, where we saw spreads tighten over 100 basis points in 1 week. Well, taxpayers are no longer the first in the firing line when a bank gets into trouble. It's now subordinated bondholders who take the hit, as we saw with S&S Bank earlier this year. So when Monte dei Paschi, for instance, this week raised capital, it avoided the risk of nationalisation, and nationalisation is a disaster for subordinated bondholders because they get bailed in and can lose everything. There's two issues really with subordinated debt. There's the bail-in issue, and there's also, in terms of CDS, there's the change in the ISDA definitions, which will result in a new credit event for bank bail-ins. That's affecting legacy trades because it only applied to new trades. So that's compressing the spreads in subordinated financials. If you look at the basis between the Markit iTraxx senior financials and subordinated financials, it's at its lowest level for some time, around 45 basis points.